You often hear people say you should buy the dip. That means that you buy into the equity market after it's fallen by a certain amount. However, if you follow that strictly, it actually performs very poorly relative to a really simple strategy of just drip feeding into the market. So we'll see why that's the case, but also at the end of the video, we'll see why sometimes buy the dip actually might not be so bad after all. So let's look at buy the dip in a bit more detail. If you're buying the dip, the question is which high should you measure your dip relative to? So for example, if you buy Brazilian equity, it hasn't really recovered since its peak in 2008. So in fact, you'd have been buying the dip ever since then. And so that's one reason why using the all-time high as your benchmark probably isn't a good idea. So an alternative is to look back over a year and use the highest point over that period. So in this graph, you can see the red line is doing exactly that. Notice how the high here looks back over the previous year, but then once that 2008 peak rolls out of the 1 year window, you can see that the high actually falls. So in this way, this strategy adjusts continually based on the previous high over a shorter period of time. So it's much more adaptive. And this also means that if your market is trending downwards, you're not continually buying into that falling trend. So in this video, we're going to do a simple comparison between drip feeding into the market and a buy the dip strategy. So the drip feed strategy we're going to use is that you're going to receive $1 every month, and then you simply buy the S&P via a tracker, say. And then after a 30-year period, you sell your holdings. And what we'll compare that with is a buy the dip strategy, where again, you receive $1 per month. And then if the S&P is below the 1 year look back period maximum, then you buy equity with all of the cash you've accumulated up to that point. If you're not below the dip, then you simply don't invest your dollar. You hoard your cash until you fall below that threshold. And again, we realize our profits by selling after a 30-year period ends. Why 30 years? Well, most people invest over a roughly 30-year window. What does that look like in practice? Well, in this top panel, what you can see is the value of the S&P since 2000, and the red line is actually the 1 year high with a 1 year look back period. The dashed red line you can see is actually 80% of that all-time high. When we're above that threshold, we don't invest each dollar that we receive. Instead, we simply accumulate our cash. But then when the S&P falls 20% below that high, that's when we buy. We take all of our accumulated cash and we buy equity. Every bar that you can see here represents every single 30-year period since 1900. And what I've done is compare the return for a drip feed strategy versus the buy the dip strategy for that threshold. So if we're sitting on this 100% line, which is the dashed red line, that means the two strategies give exactly the same return. If we set our dip size to 0, then we're continually buying, just as we would be for drip feeding. So that sits exactly at 100%. But as we increase the size of the dip at which we buy, you can see that the performance actually gets worse. These bar plots represent the best case, that's the top of the line, the worst case, that's the bottom of the line, and the most likely case, the median outcome, is the dark black line. So you can see the typical outperformance gradually gets worse as you increase the size of the dip at which you buy. When we start buying only for huge dips of say 60%, you can see the outcomes become much more dispersed. So in the typical case, buy the dip underperforms drip feeding. But as we see in the extreme cases here, there are cases where buy the dip actually works quite well. But these are very odd circumstances and quite rare. Well, I think a good way to illustrate that is to look at the best case over this period since 1900. And that was the 30-year period from 1912 to 1942. The key thing to notice here is that there wasn't much of an equity trend over that period. The S&P entered it and left it at roughly the same level. Now, normally over a 30-year period, equity markets drift upwards. So this is a very rare case when that didn't happen. If you're continually buying stock, then every dollar you invest at the beginning will compound a lot over a 30-year period if you have that drift. And because there wasn't a drift in this 30-year period, that means that the buy to dip strategy has a chance. Here we split up the returns for the various strategies. So buy the dip's cash holding is in green, buy the dip's stock holding is in red, and the drip feed return is in blue. Notice how there was this red hot rally up to 1929, and during that period, the market never really dipped, certainly not below the 60% threshold. And that means that the buy the dip strategy was continually building up its cash reserves during that period. Then well after the crash had happened, you can see that the buy the dip strategy then bought into the market at the very bottom. Following that, the equity market return was very strong. So by holding back money until the crash happened, this was an absolutely perfect scenario for buy the dip. Unfortunately, after that, much of the outperformance starts to fade away. And that's because the buy the dip strategy was building up its cash reserves again. So this combination of no drift over a 30-year period, combined with a very good signal following the 1929 crash, with a very strong rally that followed, was a very unusual and perfect scenario for buy the dip. But that is not the typical case. Now let's look at one of the worst scenarios for buy the dip. And for this scenario, our threshold for buying was a 20% fall from the previous 1 year's high. Notice that in this scenario, there is a very strong drift upwards that immediately puts buy the dip at a disadvantage. So this period begins in 1975, and between then and the 87 market crash, returns were pretty good, but the buy to dip strategy never kicked in because there wasn't a 20% fall. And that means buy the dip was in cash when the market was actually rallying very strongly. After the 1987 crash, the buy the dip strategy got into the market, which is good, but by that time, half of the period was pretty much gone and all of the compounding effects would be lost. So by then it was too late for this strategy. Then in the second half of the period, you can see that the cash was again being built up by the buy to dip strategy. The buy the dip strategy didn't kick in again. That's because there was a steady rally with very few dips. Only when we get to the dot-com crisis does the buy the dip strategy buy equity again. And in fact, when it did so, there was still further to fall. So the reason why buy the dip usually underperforms is because markets usually trend upwards. Also, if there is a crash, it may be a false signal. Markets may still fall further. So that's why almost all of the time, you're better off just drip feeding into the equity market. Ignore the price, just keep drip feeding. That's how most people earn. So it makes sense to invest in the same way. If you want to learn more about investing, a great way to do that is as part of our Patreon community. That way you get access to our investors chat forum, so you can chat to me and other members of the community. There's also a huge and growing library of video content, which is members only. And you also get regular webinars where you can ask any question you like live. If you want to learn more about that, just click on the link above me and in the description beneath me. So given that buy the dip almost always underperforms simple drip feeding, why would you ever want to do it? Well, the answer is partly psychological, but it's also to do with risk. Now, there's actually a very good paper about buying the dip called Buy the Dip by Shofi and Simon, which was published in 2021. And you can see some of the results of that analysis in the table beneath me. Now, they found, like I did, that if you just look at the economic returns of this strategy, generally it underperforms simply drip feeding. So what you can see here is MDD, that's the maximum drawdown over a 3-month period. And when that was 20%, say, that gave you the best results. You can see that in the period between 1995 and 2021, the value of that strategy was 1178. If we compare that with the passive strategy of simply continually buying, you can see that the buy the dip strategy underperformed. In fact, that was the case whatever the look back period, whether it was 3 months, 6 months or 12 months, and whatever the size of the drawdown which triggered purchases. So this is encouraging because it shows my analysis was at least partially true. Now, maximizing return is one thing, but sleeping well at night is another thing, and it's also important. So what some people do is look at risk-adjusted return. So that looks at the number of units of return per unit of risk taken to generate that return. And if you're taking a lot of risk to generate the same return, that gets scored down. But the question is, what measure of risk should you use? Generally, people use something like volatility. Volatility measures how much markets move in a typical year, and it weights up moves equally to down moves. Now that seems a bit weird because if we're thinking about risk, we'd only worry about losses, not gains. So if we look at a risk measure which does only consider losses, it's called the Sortino ratio. So instead of dividing by volatility, you measure by downside deviation. So you ignore the right-hand side of the return distribution and you only consider the downside. The bigger the downside, the bigger the downside deviation. So ideally, an investor would want lots of return with not much downside. That will give you a big Sortino ratio, which is a good thing. You get big returns and you sleep well at night, hopefully. So if we add the Sortino ratio to the table, and you can see the results of the 3-month drawdown strategy above me, the Sortino ratio is actually higher for the drawdown strategy, the buy the dip strategy, than it is for the purely passive strategy of continually buying the index. The Sortino ratio for buy the dip is 1.75, which is higher than the 1.6 for the passive strategy. In summary then, most of the time it doesn't make sense to buy the dip. You'd be better off simply drip feeding into the market, whatever the price. But psychologically, it may make sense for you to do the buy the dip. That's because it reduces the volatility of your portfolio, so it produces greater risk-adjusted returns. You may sleep better at night. Personally, I think I'd go for the drip feed option and simply weather those drawdowns stoically when they occur every decade or so. Remember our Patreon offer? You get lots of goodies if you sign up. There'll be a link to that in the description. And as always, thank you for listening.